Okay, we're live. Good morning, everybody. It is Wednesday, therefore it is our weekly webinar, and today we have a special guest in Thomas Balis. I'm going to introduce Thomas in a moment, but you can say hello, Thomas.
Hey guys.
Um, so this is a really great webinar for us today. This is a client-only webinar, and Thomas and I were talking. It's like a family discussion. And we do this as client only, so we can really talk about some details. You know, when we do a general webinar for the public, we can't talk about specific investments, specific strategies, but we can dig in more, and we're going to talk about those things today. We can also answer your questions to some degree. So we can't we'll figure out what we can and cannot answer. And it really has to do with time and maybe some things that we want to take offline. But if you can chat, and hi, Denise, I see you already. If you can chat, use the chat bar. And if you can't, you can always email us at questions@attleborowealth.com. That's questions@attleborowealth.com. And I'll put that in our chat feature. I'll send you a chat with that email address if you missed it, because I know some of you have told me that even though you've signed up, you're subscribed to YouTube and you have your own YouTube channel, that you cannot chat, which is weird. But Emily, hi, Emily. Good to see it. You know, Emily, I was thinking this morning that you should really be on this webinar, and we're going to talk about the role you play in the investment committee. But good morning, Keith. But I appreciate that. All right, so let's go through it. I'm just looking at my notes here. So just want to remind you that today is a different format. I'm not going to talk about the markets and the Slott updates. We're just going to let Thomas speak about some things. He's got a bit of a presentation that he put together for you. And I want to remind you of the goals that I have for you folks. And that's be inspired to make changes, to open your mind to different ideas and different ways of thinking about planning and investing, to stay educated so you feel confident in the plan and strategies that are put in place. We're going to talk about some unique strategies that we use in our investment portfolios that I'm very excited about, and some other things that we do just to monitor portfolios. But, you know, it helps you to stay educated so you have that confidence in these strategies and to stay updated so you can make adjustments along the way and understand, you know, if we come to you with changes to make, in your plan or your investments, so you have some idea of why we're doing that and some background on it. So let me introduce Thomas. So you've all heard me talk about Cornerstone Portfolio Research and how we started with Cornerstone back in 2022. We really joined teams to help develop our portfolios. I've told you all this, but I'm going to just say it again. You know, in 2020, we liquidated all of our bond holdings early on in the year. Interest rates were rising very quickly. Bonds were falling, and we went to cash. And while that worked out very, very well for our clients, we saved probably millions of dollars, you know, in potential loss for our clients. As we were coming around towards the end of the year, I knew it was probably inappropriate to hold that much cash. And I also knew that we needed some additional professional help. And I found Thomas and his team. After swinging a couple different times and looking for the right people, I found what has turned out to be the right people in Thomas and his team. So we have a team of chartered financial analysts and a dedicated trader on our team work very, very closely with us. And I've never been more proud of the investment portfolios that we have than we have now. But let me talk a little bit more about Thomas. So Thomas founded Cornerstone Portfolio Research in 2020 with 20 plus years of experience in the investment and financial services industry. Investment management is truly his passion. Helping advisors and their clients achieve their goals and dreams is his motivation for getting out of bed every day and his way of making the world a better place. Thomas holds a Bachelor of Science in Business from Ohio State and has since earned the Chartered Financial Analyst CFA designation, as well as the Accredited Portfolio Management Advisor and Chartered Mutual Fund Counselor certifications. Thomas spent a decade helping investment reps grow their books at JP Morgan Chase and is a former member of the RIA Executive Advisory Council for PIMCO. He is also a member of the CFA Institute and CFA Society of Philadelphia. Most recently, Thomas was the chief investment officer at Hoover Financial Advisors. While there, he built an investment program that helped the firm skyrocket from $400 million to $1.2 billion in assets under management in just 5 years. Thomas was born and raised in Ohio and has called Philly home since 2015. He has three wonderful kids, Simon, Chloe, and Zoe. So how's that, Thomas? That's right off your bio. So obviously I was reading that.
What a great introduction. Thanks so much, Mark.
You're welcome. You're welcome. So really, really strong background, and one of the you know, Scott Betton is another person who's on our team, also a chartered financial analyst, charter holder. And then Arthur, and between the three of you, I think we talked about it before. There's probably 80 plus years of experience, right, in investment management.
For sure.
All right, so Thomas, I'm going to let you roll with it here. I've got some things that we talked about. I know you're going to cover, and maybe some other things might pop up along the way. But I'm going to let you run with what you put together for us. And what I'm going to do in the background, folks, is I'm just going to pay attention to any questions you might have via email. Oh, and I'll put that in chat, or on the chat feature.
Yep. So it's great to be with the Attleboro family. And today I want to spend a little time talking primarily about three areas. So we'll spend some time diving into, current economic outlook. So how are things going in the economy currently? And then, secondly, how do we see, the markets and the economy moving forward in light of the recent election? And then finally, what are we doing about it in our investment portfolios? Because we want to tie in kind of that backdrop into how are we using that information to manage your investment portfolios. And then of course we'll take questions throughout and at the end as we go through that material. So I'm going to share some slides that I put together, and let's see if I can share the right screen. Okay, so I put together the slide deck using the JP Morgan website. They're one of the asset managers that we do some due diligence with, and they have a friendly tool that makes this easy to do. And so we're going to start with economic growth and how are things going in the economy. And so as you take a look here on this chart, this is a chart that measures GDP. And you can see here for the most recent quarter over quarter, our economy grew at 2.8%, and year over year grew at 2.7%. And so those numbers are down ever so slightly from the second quarter, where we were at 3, but still well above the long-term trend. You can see this light blue line, this dotted line, that shows long-term trend economic growth is around 2.1%. And as you can see over here on the right-hand side of the slide, the vast majority of what drives the economy here in the United States is consumer consumption. So as goes the consumer in the United States, so goes the U.S. economy. And so, by any objective measure, the U.S. economy is performing well and is strong, particularly as measured here by nominal GDP growth. Secondly, that we hear a lot of discussion about and continue to keep a close eye on is inflation. And so we know that in response to the COVID epidemic and all of the vast amount of both fiscal policy as well as monetary policy that stimulated the economy, we saw inflation move up dramatically. And this chart's very busy. But this chart breaks down contributors to headline CPI inflation. And there's a couple of different ways inflation is measured, but this measures the consumer price index, which simply measures the change in price of a basket of goods, that the BLS measures. And so you can see here back during 2022, when inflation was at its peak, we were running 8 to 9% headline inflation. And these different colors are just where it was coming from. And so the green is energy, for example. So you might remember gas got quite expensive, and it remains quite expensive, but not quite as bad as it was. But we saw gas prices really shoot up. We saw food prices really jump up and have stayed high. We saw goods prices go through a big increase because of the supply shocks that we had during COVID. As we came out of COVID, you started to see dining out and recreation really expand. But the big number that has continued to be a big, the dominant factor in inflation is this dark blue at the bottom, and that's shelter costs. And so the cost of rent, or the cost of what they call owner's equivalent rent, which is, it's kind of a funny way of measuring it, but it comes down to what would you have to pay in rent if you were going to rent the home that you own. So, housing prices, have continued to, increase and grow, and the cost of shelter is a big determinant in inflation. So, the long and the short of it, though, is that we saw a sharp decrease going from 9% down to 4% over the course of a year while the Federal Reserve was raising interest rates. And then since, the spring of 23, you can see here it's been a much more gradual decline from this 4% area here, all the way down to the most recent measurement, which came in at 2.4% for the headline inflation number. And so, we've seen that number come down more gradually over the last year and a half. And the core number has even ticked back up even slightly in the last couple of months. So it's something that the Fed is watching closely. And it's important to note the distinction between, inflation and overall price levels. Because if I talk to my wife and say, well, inflation's down to 2.5%, she'll laugh at me and say, have you seen our grocery bill? It's like 50% more than it used to be. And, inflation just measures the change in price over the last 12 months. And so when our sense of prices are typically more anchored back a little bit farther. And so when we think of our grocery bill, we're thinking of what the bill was maybe pre-pandemic. But the reality of it is that, for us at least, the grocery bill went up significantly and just remains elevated, even though the year-over-year increase maybe is flat. It was expensive a year ago, and it's still expensive. But it's not getting even more expensive, so to speak. So that's
Thomas.
Inflation.
Sorry, Thomas. These are really great points. Can you talk about what headline inflation is? Like what?
Yeah. So headline inflation.
What does that definition mean?
Yeah, so headline inflation includes some of the more volatile figures like food and energy. So energy costs, can be very volatile depending upon the price of oil, for example. And so because those numbers fluctuate, they come out with two different measures. They come out with a headline number, which is what you see on the numbers here, the current one being 2.4. And then there's the core number, which takes out some of the more volatile things. Like energy, and that's what the absolute measure of the top of the bar is here. So typically when the Federal Reserve looks at inflation, it looks at core inflation, and specifically it uses a slightly different measure. It uses the Personal Consumption Expenditure Index, PCE inflation. But regardless of whether you use CPI or PCE, and regardless of whether you're looking at core or headline, the observation that I would make here is that the general trend has been down. Now, it's not necessarily down all the way to the Fed's long-term goal of 2%, but it's a lot closer than it was. We are in the twos, if you will, the 2.8, 2.5, 2.4 over here on these last three measures.
Let me ask your opinion on the Fed goal. And we didn't talk about this, so I'm throwing you a little bit of a curveball. I'm sorry. But do you think that 2% goal is reasonable?
Well, the reality of it is that if you look at long-term inflation numbers, like going back 100 years, the longer term average, and the average that's often used in financial planning modeling, is 3%.
Yeah.
And so if you take when you factor in that in the 70s, inflation was double digits over extended periods of times, and even in the early 80s. So there's been periods of high inflation and periods of low inflation. 2% is the number that the Fed picks out as, what they consider price stability. The Federal Reserve has a dual mandate, full employment and price stability. So they've picked out 2%. Whether it's 2% or 3%, as a realistic goal, I think, you could make a lot of arguments either way. I think given the scope of the government deficit, I would have to think that even if they don't officially change their target to 2%, allowing inflation to run between 2 and 3 for extended periods is probably what's going to happen, because that will make the total amount of debt that the U.S. government has, it will become less over time relative to the economy.
Yeah, interesting.
Yeah. So if they allow inflation to run a little bit hot, 2.5%, 3%, adds up when it's over a 10 or 20-year period.
Yeah, so I appreciate that commentary. So Emily, just remind me, we reset our inflation number, I think, to 3.5%, during the heat of the pandemic. And I hear you that the 100-year average is somewhere around 3 and 3.5. I might be. You said 3, so I'm just gonna hang my hat on that. But Emily can text everybody or message everybody. I think we're still at 3.5% in our projections. And as we're talking, I'm seeing that CPI just came out, and it looks like came in at 2.8 compared to 2.7. What was expected.
That's the headline number.
What's that?
That's the headline number.
The headline number. So while we're talking about it, so what does that mean when we see? And I want to make sure I didn't have my glasses on when that scrolled, so I'll make sure that that's the number. But and PCE looks like it was right on estimate. But when CPI is slightly over what the estimate was, what does that mean?
Yeah.
And what does it mean to the markets, I should say?
Yeah, for sure. So the markets tend to look at better than or worse than expected, more so than absolutely good or bad. And so when they say better than expected or higher than expected, they take surveys of different Wall Street economists and say this, how are you doing your forecast and what are you expecting the number to be? And they average them together and say that's the street expectation. And then they compare that against what the number actually comes into. I think in terms of market participants, we tend to look at trends more than any one reading. So what is the trend? And so the trend the last couple of months is that, it's come in just a little bit, a tick above expectations over the last month or two. And so it's one of the reasons why when you ask folks, what's the likelihood of a Federal Reserve interest rate cut? The market right now puts that likelihood at around 50%. When the Fed did their forecast back in September, they said that that they would expect they decreased interest rates by 0.5% then, and they were forecasting to decrease rates another 50 basis points before the end of the year. Now we know they did another 0.25% at their last meeting, and so based on what they told us in September, we would expect in December that there would be another 0.25% cut that they would be doing. But the market sees these little ticks up and says, well, if inflation is starting to, flare up a little bit, the Fed may have to slow down. And because when they're decreasing rates, they're taking their foot off of the brake, right? They've had their foot on the brake of the economy by keeping interest rates higher than the neutral rate. And in fact, I've got a slide here, a couple of slides down here that talks about that. Okay. So you can see here on this slide, this is kind of busy, but this gray line is actual interest rates. So you can see here right now the interest rate that the Federal Reserve sets. And again, this is the overnight rate that banks charge each other. This is not the rate on your mortgage or your car. This is just interest rates that banks charge each other and that Fed policy governs. So they've got it set between a range of 4.75 to 5%. And so that's why this chart shows 4.8 as the current rate. So right now, the market expectation and the Fed estimate is that they'll cut that down yet again before the end of the year. And so, and then as I mentioned earlier, this blue line is where the Fed last told us the direction of interest rates that they expect. The green line is what the market thinks they're going to do. So you can see here that based upon these recent ticks that we've seen in inflation, the market's like, well, we know that you said you were going to drop rates by, full percent in 2025 when you last looked out that far in September. But based on the recent inflation reports that have gotten just a little more heated, we think it's more likely that you will maybe only cut half of that. And so that's what this green line is showing, the market expectation. And then this purple dot down here is the Fed long-term projection. So the Fed looks at rates long-term and says the neutral rate of interest rates, the rate that neither stimulates the economy nor slows it down, is around 2.75 to 3%. And so that's why it shows 2.9 here on the chart. So that's where they see rate as neutral. So when they're cutting rates, when they cut rates in September, when they cut rates last month, if they cut rates in December, it's not that they're necessarily trying to stimulate the economy. It's is that they're trying to take their foot off of the brake that they've had on the economy because they had to raise interest rates to bring inflation down. And so that's why rates have been higher than they had been historically. One of the things that's enabled them to do that, Mark, is that wage growth has slowed. And so, the other part of the Federal Reserve mandate is full employment, stable employment, right?
Mhm.
So we saw unemployment that shot up in April of 2020 to 14.8% as the government shut down significant portions of our economy. And now you can see that most recently in September, that rate was 4.1% for unemployment. And while we've seen a lot of numbers with three handles recently, this gray line right here, the reality of it is that, when you look at long-term unemployment, the long-term average is 6%. And if you ask most economists, well, what is full employment? Where you're always going to have a little bit of unemployment as people transition from one job to another. Most economists would say that 4% is what would be considered full employment. And so, when you see these periods where we're below 4%, that means that the labor market is running very thin in terms of there's more job openings than there are people to fill them. So 4.1%, most people would consider a very solid unemployment number, a tick higher than the threes we had seen recently. But the other thing is the wage levels. So, wage growth is good. Don't get me wrong. Everybody likes a raise. I like a raise, right? But when we saw goods inflation really spike during COVID, we saw wages have to go up too. And if you think about that, at least in this area, I remember during COVID, you would see signs at Wawa or signs at Giant that was paying $17 an hour or $15 an hour to starting, a much higher starting wage than you had typically seen at places like that. And
Right.
so that created a wage growth spike, if you will, that contributed to inflation. So as people see higher prices, they demand higher wages. And then as companies pay higher wages, then they start raising their prices to cover of them. And so, if you're not careful, you can get into what's called a wage price spiral. And that's why the Federal Reserve, raised rates as high as they did was to slow that down. And you can see the most current estimate showed wage growth near its long-term average. 3.9% was the September number, and the long-term average number here is right at 3.9%. So with wages having stabilized and unemployment being at relatively full and stable, that allows the Fed to say, okay, we can ease our foot off of the brake on policy. We can allow interest rates to come back down closer to neutral because this part of the equation has stabilized and inflation is not crazy high like it was before. So
Great.
a lot of stuff going on there, but the Federal Reserve meets again here in December, and right now the market outlook is that there's a 50% chance that they'll follow through on that 1/4 point interest rate decrease that they forecasted in their last forecast.
Yeah. And let me just define something when Thomas mentions 50 basis points, 25 basis points. What that means is 0.25%, for instance, 25 basis points is 0.25%, and 50 basis points is 0.50%, or one half of 1%, or a quarter of a percent. Um, but we have a question, Thomas. So John comments and asks, sure looks like food is the largest contributor to inflation. It, how does the government attack that to bring the overall inflation down? He asks.
Yeah. So want to distinguish between uh, absolute price levels and inflation. And so you can see here that food at home, this is purple. The cost of food was a major component driving um, the the high inflation that we had. And the reality of it is that it's something that we pay close attention to. So it gets a fair amount of mind share from us. If you look actually more recently, the more recent increases have come from car insurance. And if your car insurance hasn't gone up recently, you should give your insurance agent a big kiss, because I hear from a lot of people recently that car insurance rates have gone up, and because the cost of parts and the cost of labor have gone up, and there's a lot more technology in cars and so forth. But back to the question, how does the government, tackle food prices? And the reality of it is that it's difficult, right? So I think we've seen a big surge in optimism when you take a look at where the stock market is recently, for example, with the recent election, on the hopes that that less regulation, that more liberal energy policy, that lower taxes can help. And so, one of the ways that you might think about that is that maybe isn't intuitive, though, is oil production. And so you might say, well, what does oil production have to do with food? Well, believe it or not, it has a lot to do with it, because as oil prices and fuel prices are higher, then the cost of transporting, the cost of manufacturing food, the cost of transporting food, that goes into the cost of food. And so, one of the things that can have an impact there is as the new administration has talked about, you hear the phrase "drill, baby, drill." There's fewer restrictions on domestic oil production. One would think that gas prices, diesel prices could come down, and certainly, oil prices by the barrel are lower than they were historically, although they did spike with the Middle East tension. And so that's one way that the government can impact food prices. So another way is through the decreased, regulation that you see. And so um, as food producers are required to spend less of their time fulfilling government mandates, that should free up, more bandwidth for production and/or, prices coming down. So that would be a couple of examples, but the reality of it is that the government doesn't directly set food prices.
Mhm.
We heard some talk in the campaign about price gouging and kind of going after that. The economist in me says that price controls tend to backfire. They have unintended consequences. And so it's one of those areas where they're going to have to attack it indirectly, I think.
Yeah, it's interesting. A correlation between different things that you may not be thinking of is interesting. And you're talking about energy prices and the food that ends up at our grocery stores and on our tables. The I think it was your report last week or the week before that was talking about how the energy costs affect the housing market, right? And where people are where new housing is being built is further and further away from kind of the metro hub, right? Because that's where the land is, and somebody who's hired to work on that job site has to not only consider their wage, but they have to consider the cost to get to that job site, and that they're driving an hour to get there. And if the quarry trucks are driving further to get there, and the lumber delivery trucks are driving further to get there, that all spikes the cost of the end home, right? And so the food is very, very much the same. It's really interesting.
For
Good
sure.
question, John.
Yeah, it is a great question because my wife's tired of paying $5 for a dozen eggs, believe me.
Well,
Although
if it makes you feel better, I have chickens at home, and so I pay like $50 for a dozen eggs because we have our own, and I
okay.
give most of them away.
So, but I think that's a great segue to talk a little bit about. So we've talked a lot about how where the economy is. We've talked about economic growth, we've talked about inflation, we've talked about unemployment, we've talked about interest rates. So we had this thing called the election a few weeks ago, right? And and you have to, and there's been lots of news since then. We're going to have ostensibly a unified government where you have a Republican Congress, a Republican executive branch, and overall a fairly conservative Supreme Court. And so, there's the thought of high expectations and what I would refer to as animal spirits that have driven the market to recent highs. If you take a look at, the stock market most recently, the S&P 500, the last, through the year-to-date number is up, 25, 26%. The NASDAQ 100 up close to 27%. And these numbers are a couple of days old, but they're pretty close. And so you've had really strong stock market bounces since the election. And there's the thought that the hope of markets is that with the possibility of lower taxes, with the possibility of less regulation, with the possibility of a friendlier merger and M&A environment for big companies to get bigger, the stock market likes that and has rebounded and had a nice bounce over the last few weeks. Although it's definitely become more up and down here in the last week or two. And we had a very strong initial bounce. And the reason that slowed a little bit is that, you have some of that initial enthusiasm, but then you have to ask yourself, well, how much of what we've been promised is actually going to be able to happen, right? And, imagine that, hearing campaign promises that don't necessarily actually come true. You got to love America. We have the worst government in the world, except for all the rest of them. So, so you have to say, okay, well, we have a unified government, but the margin in the U.S. House of Representatives is razor thin. And so, you have a couple of folks that don't play along, and all of a sudden, it's not as easy to get some of those bills passed that you want to get passed. And so, what does that do? That forces compromise, right? That forces, less big change. The market doesn't like big change anyway. The market likes predictable change.
Right.
So you have to ask yourself, with a very narrow margin of a majority in the House in particular, how big can the changes be? Whether that's on taxes, and I think the consensus is they'll find a way to extend the individual tax cuts that were done back in 2017, but then they're going to have to come with trade-offs, right? They got to figure out how to pay for that. So the other big thing that could have a big impact is on immigration. Enforcing immigration laws and restricting the flow of immigrants across the border to more rational levels. But then also there's this talk of deportation. And on the one hand, you've got a lot of people in the country illegally. I mean, the number you often hear is 1 million, that there's 1 million folks in the country illegally that are criminals. And I think most of us would be excited to see the criminals get deported. But then you hear numbers anywhere from 10 to 20 million above that have come in illegally over the last several years, and that maybe they're not criminals, but they're not here legally either. But it could very well be the people that are both highly skilled that just that don't have a green card, and maybe they're working in um, tech or medicine or something like that. But then also a lot of more entry level labor positions that maybe some Americans don't want to do, whether that's landscaping or the person that makes the beds in the hotels or those kinds of things. Those jobs have to be filled too. And so you have to ask yourself, if we deport a bunch of those people, and the President Trump announced that would be the biggest deportation ever. If you deport a bunch of those people, those jobs have to be filled. And so there's the risk that if jobs have to be filled and we don't have enough people, that you start to see wage inflation go back up as companies have to pay more to attract workers. And so that's the risk. And so the question then is that, well, how much of that should we depend upon? And one of the things that I heard over the last several weeks, and that I think makes sense to me, is that President Trump is a person that you have to take very seriously, but not necessarily always very literally. That there are times that he can either exaggerate or maybe come out very aggressively on a stance for a particular area as a negotiating tool in the hopes of getting a more rational middle ground actually accomplished. And so, the reality of it is that no one knows exactly how aggressive things will be, whether it comes to immigration, whether it comes to tariffs, whether it comes to how successful he'll be with tax cuts or some of the spending programs he wants to do. So with a narrow divide in Congress, with parts of the country that maybe lean more Democrat than Republican, holding things up in the court system in terms of immigration, slowing that deportation down. You just don't know exactly how all of that will come together to impact the economy. I mean, I think we've heard a lot in the last week with the new Treasury Secretary nomination, Scott Bessent, I think is his name. And a lot of his talk was, especially on tariffs, for example, was that, hey, he loves the idea of the threat of high tariffs as a negotiating tool to get other countries to lower the tariffs that they're charging us, or to get other countries to stop the illegal flow of fentanyl or immigrants into our country. You heard that most recently. And so, I say all of that to say, there's been a lot that's been talked about. No one knows how much of it will be able to become policy, and in particular, how quickly it can become policy. And then we know that these kinds of policy impacts act with long and variable lags, right? On day one, we don't see 20 million people deported. It doesn't happen that fast, right? We don't even see the million criminals deported on day one. That probably takes some time, and then that spillover effect takes time to hit the economy. And so because of that delay, and because of the fact that what's been promised and what actually happens are probably going to be two different things, we have to kind of fall back on where things are now. And the reality of it is that we have a decent economy right now. We've got stable employment. We've got inflation that has come down. And so our outlook going into 2025 is cautiously optimistic, because when all else settles down, when the noise settles down, the stock market is valued based upon the earnings of companies. And when economic growth is good and the consumer spending money, companies do well and they make money. And those earnings then translate into higher stock prices and higher values in your portfolios.
And interesting. I appreciate all that commentary, and I want to just remind everyone that the conversations about President Trump or policies, these are not political positions at all. This is look. This is the reality, and this is what we're. Their platforms have been very, very clear. I think what's important about what Thomas just said, and maybe you could take away, there's a lot of good stuff there, but is potentially unintended consequences, right? And whether it's um, unintended consequences of a more open border or a more closed border or tariffs, and we won't know. We really won't know, or continued tax cuts. Keeping tax rates low is great for us from a planning point of view. And I've said this openly, but it's terrible for us from a um, financial viability of our country point of view, right? There are some things that I've said on this webinar over and over again. I could never run for office again because I've said we need tax increases, right? To fund just everything that we have to fund in our country. There really isn't something that's a catalyst out there that's going to pay for the $35 trillion in debt and Social Security and Medicare and all the different agencies and promises that we have to pay for. But I'll take these cuts now because it gives us all, this family here that we have of our clients, it gives us all the opportunity to get you folks off the railroad tracks, which is most important. And I wish we could help everybody, but we can't. And people around you are going to suffer, unfortunately, but hopefully, we'll get done what we need to get done for you folks. But and I appreciate it, Thomas's comments. I just wanted to clear the field and have that discussion that this is, again, not a political discussion.
Yeah, for sure.
Yeah, thank you.
And then the other side of that too is that there's the question of, okay, how much gets done versus what was promised.
Yeah.
But then the other part of the equation, Mark, and it's really the thing that's impossible to predict, is how does the market react to it, right? There's what happens, tariffs or tax cuts or spending cuts or deportations or whatnot. There's the things that happen, and then there's how the market responds to it, because it's really strange in some ways that sometimes the market says good news is good news, and sometimes the market says bad news is good news. Because when there's bad news, then that makes it more likely that the Federal Reserve will cut interest rates, and markets like low interest rates. And so you never quite know how the market might respond to what we see happening with the new administration. But there's a couple of things that I think are important for us to keep in mind. And so this is a chart is talking about the S&P 500. And, the stock market, as I said, has had an enormous rally this year. And a lot of that has been driven by the very biggest stocks. And so when you take a look at this chart talks about the PE ratio, and that's simply the ratio of the price of a company's stock share relative to the earnings that it generates per share. So for example, if a if a company is generating $10 in earnings per share of stock, and they're trading at a multiple of 20 PE, that means that stock would be trading at $200 because it's trading at 20 times its earnings. So, multiples stocks are fundamentally valued upon, what their future earnings are likely to be. And stocks that are likely to have higher rates of growth, both in terms of revenues and profits, tend to trade at higher multiples. They're more expensive. Stocks that are, less likely to generate growth trade at lower multiples. Those tend to be what we would call like value stocks, for example. But you can see here these big names. So the Microsoft and Apple and Tesla, the big mega cap names, have really been driving a lot of the growth in the market, and they're responsible for how expensive it is in large part, because you can see here that the S&P is trading at 21 times earnings. The top 10 are trading at 29. The other 490 are actually a lot cheaper. They're only 18 times earnings. And so I know those numbers can be a little bit confusing, but the moral of the story here is that the other 490 stocks in the S&P 500 are a lot cheaper relative to their earnings than the top 10. And so as the market continues to broaden, to demonstrate breadth and to reward companies that are growing, that aren't those big mega cap tens, that aren't named Apple or Microsoft, then we can anticipate that the market would continue to grow next year. That being said, you compare these numbers relative to their average, right? And they're trading currently above their average, right? Long-term average for the S&P is to trade 16 times. It's currently at 21 times. So you would say it's trading expensive relative to its long-term average. And what that means, you might hear the phrase, and if you ever watch financial news, you'll hear markets are priced to perfection. What that means is that markets have priced in a lot of good news. Markets have priced in a lot of optimism for the new administration. And again, that's not saying good or bad. That's just saying the reality of what it is. The market has positively responded to the announcement of the new administration. And if there's anything that comes in, any bad news could cause a sharp drop, right? Because markets are already pretty expensive. It would take, extraordinarily really good news for them to shoot up super high again. And, for us to have a third year where we gain 20%, for example, would be really tough given how current market multiples stand right now. And so you take a look here, and this chart's kind of busy, but this S&P 500 shows the annual returns over the last looks like 44 years. And so now this is through October, this chart is. So you can see here, it's showing the market's up 20%. That's through the end of October. It's up more like 26% right now. And when I say the market, that's US large stocks, the S&P 500. So you can see here, over the years, most of the time the stock market's up, right? I mean, if you look, it's positive 33 out of 44 years. So 3/4 of the time it's up, 1/4 of the time it's down. That's the bars, if you will. But during the year, on average, there's on average an intra-year drop of 14%, somewhere in the year from peak to trough. Some years it's more, some years it's less. So if you look at last year, the biggest drop in the market was in the midst of the year, a couple years ago, actually, was 10%. So I think that's 2023. If you go back here the prior year, it dropped by as much as 25% in 2022. It didn't end down 25%, ended down 19. But you can see that at some point it dropped by that much. During COVID, it dropped by as much as 34%, right? It didn't end the year down 34%. And actually, the market ended up during COVID. Because of all the stimulus that we had. But at one point, it was down in the middle of the year, 34%. So why am I sharing this? You see some years have bigger red numbers, some years have smaller red numbers. The last couple of years, the declines haven't been as bad as they were. So I bring this out to say, going into 2025, there's a lot of geopolitical risk out there, right? Markets are trading at rather expensive multiples relative to themselves, and we haven't had any really big drops the last couple of years. Knowing that the average over the long haul is 14%, right? And knowing that there's some things that if they happen, right? I mean, if we really do deport 10 million people, that's going to cause a labor shortage. If we really do put 60% tariffs on everything coming from China, that's going to cause prices to go up.
Sure.
And so if some of those things really happen in extreme, that could drive the market reaction to be more volatile. And so am I forecasting a doom and gloom scenario? No, I'm not. As I said earlier in the broadcast, our outlook is cautiously optimistic. We think, given the current economic growth, more stable prices, low unemployment, we think the market is poised for a solid year next year. Not another 20+% year, but a solid year. Remember, a solid year in the stock market is 7, 8, 9%.
Yeah.
And so we think the market's poised for that, but we think that there could be volatility along the way, just given the backdrop and the fact that we haven't had as much of that in the last couple of years as you might have thought.
Yeah, that makes sense. That's a great chart.
Mhm. So, then the natural question is, okay, well, Thomas, what are you doing about it? All right. Like, what are you doing with my money? What are you doing with investment portfolios?
Right.
And so, I think I'll review a couple of principles here, and I'll go a little faster because I can see we're coming closer to the top of the hour.
It's okay. We don't have to stop right at 11, just so you
Okay,
know. As long as you're okay, we're okay.
I got as much
People
time as.
will drop off as they need to. So let me take an opportunity to say this. So this, Kathy did ask, but I'll repeat it to everybody. This will be sent out to you via recording, like every week. We It'll only go out to clients. We ask you not to share it, the recording, because we are talking about specific issues, or we'll get into specific issues. Generally, this has been fine for the public, but we are going to talk about specific Attleboro Wealth Management holdings and your accounts. So I'll just ask you not to share it, but you will receive a recording of this.
Okay, so what are we doing about it? So the first slide that I'm going to pull up here is this quilt chart. And this chart's really busy, but each square represents a different part of the market. So you can see here, this light green here at the beginning of top of 2023 is US large cap. So US large companies. The next one is developed market equity. That's international markets that are fully developed, not tiny countries that are emerging markets, but things like Europe and Japan and stuff like that. Orange is small cap. So smaller companies with market capitalizations generally under $2 billion. You see emerging markets equity. So so think, like Brazil, or India or China. China is still considered an emerging market, believe it or not. You see cash, you see fixed income. And so one of the foundational principles that we leverage in portfolios is the principle of diversification. We know every year the top's going to be different, right? So you look at small caps, and for example, you see here in 2010 it was near the top, but then it was down at the middle, then it was back at the top, then it was down at the middle, then it was losing money, then it was up at the top. So we know every year some things are going to do really well, some things are going to do not as well. And the principle of diversification is that by not having all of our eggs in one basket and not trying to predict exactly what's going to be the best, next week, next month, next year, but to instead have a broader diversified approach, we're able to stay in this middle part of the chart. And that's where you see that line, a diversified asset allocation portfolio. And so, the number one principle that we practice is diversification. And just as a reminder, since this is family, the other principle that we practice is segmentation, right? We're very mindful, of as fiduciaries of only taking the appropriate amount of risk based upon your individual tolerances, your goals and needs, and specifically the time frame that you're going to need different buckets or segments of money. And so we segment accounts often for many of our clients so that nearer term assets have a lot less risk in them. Our segment one accounts are, currently have no risk in them. They're either money market or, short-term treasury ETFs. And so interest rates have been high enough to make that an attractive investment for a segment that we don't count on to carry a lot of the return loan. And then we have, different segment 2, 3, 4, 5, where we add more stocks into the equation because we have more time before those buckets of money are needed. And so we have more time to recover in the market. And there's this slide does a great job of anticipating that. So this slide, and I'll just take you to the gray line. The gray line here is the 60-40 portfolio, 60% stocks, 40% bonds. And you can see here that if you just look at annual returns since 1950, the 1-year return for a portfolio made up like that could be as low as 20% or high as 34%. So that's why money that we need in 1 year, we don't typically put in stocks because there's the possibility that it could lose money in the next year. And we want that money to be available and not have to be sold in a down market. But look at what happens when you get out to a 5-year. So for example, if you look at a trailing 5-year return at any point over the last 73 years, from 1950 to 2023, that portfolio retained, the worst portfolio would have done was 1%, and the best was 20%, right? But when you give a portfolio 5 years, it historically hasn't lost money. Going all the way back to 1950. If you go a little farther, you go out to a 10-year period, you can see that range gets narrower even, right? And you go all the way out 20 years, and you can see the worst return is like 5%. Meaning that if you look at your, this 60-40 portfolio over the last 20 years, the worst year it would have ever had was 5%. The worst average it would have was 5%. And so the principle of this slide is that the longer time period that you have, the less likelihood that you have of losing money in the portfolio over the long term. And you can see here that the average portfolio return in this illustration, going back 73 years, is 9.3%. So, the moral of the story here is the longer time frame means less likelihood of loss. And so we leverage that principle in our segments to say, as we look at the segments that have longer time periods, we can afford to take on more risk because there's less likelihood of loss. And so as we get into those segment 4, segment 5, segmentations, we tend to have more stocks and less bonds in them. We tend to take more risk in those portfolios. And so that's kind of the first thing I like to talk about is that we believe in the principle of diversification. We believe in risk management through segmentation, right? And then the next thing that we want to do is we want to manage the volatility within those segments. And that's where,
So before you move on, Thomas,
yes.
I got to say, because I'm sitting here with a large smile on my face, but you can see me, but because you were talking, the way Zoom works, it only shows the speaker view, which drives me crazy. But I'm smiling because Cornerstone's brought a lot to our relationship with certainly efficiencies in our portfolios. We're going to talk about that in a moment. But I'm hearing Thomas talking about segmentation like we talk about. And I think it's something that's really I guess we brought the cornerstone, right? In this relationship is really this structured segmentation. I know there was a lot of folks, the first 4 to 6 months that we spent working together in 2022 was developing these portfolios, laying them out in segmentation, really teaching each other how we think about different things. The teams, I mean, the Attleboro Wealth Management team and the Cornerstone team. So if you could have seen me when Thomas was speaking perfectly about segmentation, I had this huge smile on my face because it's so important. Because when we look at these slides, one might think, well, geez, a 5-year rolling period, if I'm a 60-40 portfolio, I could just stay invested in that. Well, the concerns about that are if you're drawing money in a 2022 scenario when bonds were down significantly and your entire portfolio could be down 20%, you're drawing funds out of a portfolio with a loss. But it even gets deeper than that because these are annual returns. They're not talking about the intra-year, and people don't withdraw funds, at the end of every year or at the beginning of every year. They draw them in June and whatever time they need them. But then you also have human behavior, right? And psychology and all these things. And what happens is that portfolios fail often because of investor behavior. So there's some really famous examples, the Fidelity Magellan Fund being one of them, right? I think it was the Fidelity Magellan Fund, Peter Lynch's fund. That was Fidelity Magellan, right? Mm-hmm. So these aren't the exact numbers, but it was something like that fund returned a high number, 14% or something like that over the life of the fund. So somebody will fact check me on that, but I'm just giving you, it was a higher number. Your average investor returns something like 3 or 4% because of human behavior. So that's where segmentation really, really helps. And again, I just love hearing your description of that, Thomas. I appreciate it.
Yeah. And I will share with you that Cornerstone works with a dozen different firms across the country. I will tell you, Attleboro is the only firm that we see that actually delivers on segmentation. A lot of firms out there, they talk about asset allocation. A lot of firms out there, they talk about and do a great job with financial planning. But when it comes to actually account segmentation and actually dividing out the different buckets of money, if you will, for different time periods, and actually having various accounts for that. I will tell you that Attleboro is the only firm I've ever seen that actually executes on it. And it's a lot of work, folks.
Mhm.
It's not the easiest way to run portfolios, which is why a lot of firms don't do it, because it can be very labor intensive. But it's absolutely, from an investor psychology standpoint and from a managing risk standpoint,
Yes.
it absolutely produces better outcomes for our clients.
Yeah,
And
and
so,
a sleep at night standpoint. I'll go a little off topic here, and we'll spend another 5 or 10 minutes and wrap this up. But I was listening to a podcast yesterday, and there was a fellow who was a retired Green Beret speaking, and he's 20 plus, maybe 30 years in the Army. And what I learned from this podcast was Green Berets, they're part of the Special Forces, and they work with uh, people on the ground that are residents of the countries they're working in. Like he was specifically talking about Afghanistan and the time he spent in Afghanistan, the 20 plus years in Afghanistan, developing relationships with the citizens that were helping give intelligence to the U.S. and other countries who were involved. And now, since we've pulled out of Afghanistan, there's this veterans network that still has these relationships with people who were left in Afghanistan. And what these veterans are now, they have information that the three-letter agencies don't, right? The CIA and everybody else who's involved. Um, so this network of veterans, he was talking about this terror risk because of the border security issue and things like that. They're positing that there are thousands of potential terror risk individuals in the U.S. now who are ready to strike, and it could be 6 cities at one time, and it could be within the next couple of years, and all that's frightening when you listen to this. And I haven't done any. So when I listen to something like that, I like to do some research after the fact. This was just yesterday or the day before I was listening to this, but something like that would be devastating and terrible, and we understand that. But it would also have, of course, market shocks, and we would see dramatic drops in the market, likely if there were large terror attacks beyond the the terrible loss of life and whatnot that would happen from that. But it helps you sleep at night with the segmentation approach, because we know that we can handle shocks from the market, even significant shocks in the market, as from a safety point of view, whether it's principal protection or segmentation and the combination of it. So I know that's really bringing something that's potentially disastrous into the discussion. But listen, folks, it's the reality of what we're living through. We all saw the towers fall on September 11th. And we would hate to see something like that again. But we live in a world where that's, of course, now a possibility. I remember everybody remembers where they were. I was a brand new financial advisor within a few months, watching that in the offices of Payne Weber, and it changed everything for us. But anyway, I'll let you continue from there, Thomas.
well, so one of the things that we do, and since this is a family broadcast, we can talk about specific investments. So one of the tools that we use to mitigate the risk within the portfolios, in the nearer term. So think segment 2, segment 3, these buckets, these segments of the portfolio that are going to be used over the next, 3 to 5 to 7 years. If you were around for the global financial crisis and you had money in stocks, it took you, 4, 5, 6, 7 years in some cases to get back to even, because of the depth of the drop in the market, just depending on how you were allocated. And so one of the things that we do for a portion of the monies that are in those nearer term buckets is we use what are called buffer ETFs. And buffer ETFs simply take a part of the market, and this sheet talks about the S&P 500, that segment of large U.S. companies that a lot of people think of when they think of the stock market. We tend to think of the stock market as the global stock market, the all country world index that looks at all sizes of companies and all countries. But for this purpose, we'll look at the S&P 500. And it's a product that gives you exposure to the upside in the S&P 500, but it has some protection built on the downside. And so they have a lot of different particular mixes that they use of that. The one that I'm using as an illustration here is PNOV. And so that's down here, PNOV. And what this particular buffered ETF does is it says it has a starting buffer of 15%, meaning that if I buy this ETF on November 1st and I hold it, the entire year, right? At the end of that year, if the market is down 5%, 10%, 12%, 14%, it doesn't matter because I will be flat. I will be at zero. I'm protected with this buffer protection. And the way that they do this within the ETF is, with what they call a downside call protection, and it's a mixture of different calls and puts and so forth. But the ETF protects on the downside, to the end of the outcome period, October 24 to November 1st of 24 to October 31st of 25. So if the market's down 5%, 10%, it doesn't matter. On October 31st, I will be down zero, except for the expense ratio. So this fund has an expense ratio of 0.79. It's a little on the higher side in terms of where we like to spend expense ratio, but we think it's a good place to spend it. We have lower cost exposure in our broader market ETFs within the portfolio, so that we spend very little there, so that we have a little bit more of a budget to spend on specific niches within the portfolio like this. So when I say we're down zero, well, they're always going to get their money. So in that scenario where, if the market were down 12% on October 31st of 2025, we would actually be down the 0.79% of their expense ratio, because they're going to get theirs whether we do or not. So I just make sure that I talk about, I include that. Now, you might say, okay, well, what if the market's up? Well, every month they look at, where the derivative markets are, if you will, the puts and the calls and so forth, and they set a starting cap. And so for this particular one, that cap was 12.45%. And so what that means is, if I invested on November 1st and I hold this through the end of October, then that means that if the market's up 10% on October 31st, my fund is up 10%, minus the expense ratio. They're a little 0.79. Okay. So I get to enjoy all of the market participation up to 12.45%. So if the market's up 12, I get 12. If the market's up 7, I get 7, minus the expense ratio. If the market's up 20, I only get 12. Okay. So that's that, because there's no free lunch, right? They're not going to protect that downside at 15% for nothing. There's got to be some way that gets paid for. And the way that it gets paid for is by giving up the upside. And so we think that's a reasonable trade-off for the nearer term portfolios. For the longer term portfolios that are, 10 years out, 20 years out, we don't need this kind of protection in there, because we have enough time for those portfolios to come back. We can tolerate that volatility. But for these nearer term buckets where the money has a nearer term need, say 5 years out, we want to mitigate some of that risk by investing a portion of our exposure in buffered products like this, so that if the market, say we do have mass deportations next year and the market reacts poorly, and I'm not saying I think that will happen, but if it does, then we've got some measure of protection in the portfolio. Now, if the market dropped 20%, we're down 5, right? We have that 15% buffer. If the market's down 25%, we're down 10. So it mitigates that downside. But likewise, if the market's up 20, we get 12. So that's the way these work. And so we leverage these in different buckets of the portfolio. This example is for the S&P 500. But we also use similar products to access like U.S. large growth tech exposure. There's a product that tracks the QQQ, or the NASDAQ 100. We use it for some international exposure with a product that tracks the EFA, which is the Europe, Australasia, Far East Index, or the index which measures developed international countries. We use it for some small cap exposure, some small company. It tracks the Russell 2000 index. So we use different versions of this, depending on whether it's segment 2 or segment 3, to mitigate a portion of that risk. And then the key part of it is that it's not a set it and forget it approach. We monitor these things very closely, and I'm gonna give you guys a little peek behind the curtain. You know, we've got Wicked coming out in theaters, and so this is I'll show you a behind the Oz curtain, so to speak, here of something that we do to monitor these things. So you're seeing a spreadsheet here. It's got a lot of numbers. I'm not going to explain all of them, but I'm going to use this to illustrate a point. So you can see, first of all, down here, there's a whole bunch of dates on the bottom, a whole bunch of different tabs. And what this shows you is the different dates that we're reviewing these. And we committed to reviewing these monthly with Marks, but the reality of it is that we end up reviewing them every week. So you can see here, here's the one that we did last Friday, here's the one the Friday before, here's the one the Friday before, and so forth. So you can see here that we monitor these on a very regular basis. And what we're doing is that we're looking at the tickers that we're using this month. So you can see here's that PNOV that I talked about, but there's also an NNOV that tracks the Qs, the NASDAQ 100. There's the KNOV that tracks the IWM, which is US small caps, small companies 2 billion and less. And then there's the INOV, which tracks the EFA index, or the international developed markets. And so we pick up different amounts of exposure. And these formulas just show, again, the downside buffer, the beginning cap, how much downside's left. I'm going to take you over here to the right. This is what we look at very closely and track, not only for the ones that we're using the current month, but on another sheet even more broadly, where we look at how much of the buffer is remaining if something is down. So internationals had a tough month, right? So through Friday, the international holding was down 3%. And you might ask, well, wait a minute, Thomas, you told me I was protected 15% to the downside, right? That's true at the end of the period. So in between the beginning of the period and the end of the period, there can be some movement, not as much as the market's moving, but some movement, right? That can cause the fund value to dip. And so if you look at something at any given time, before the end of the period, it won't be as up as much as the market, or it won't be as down as much of the market, but it's going to be directionally there. And as you get closer to the end of the period, as that time value of those underlying options, gets closer to expiration, then that gap narrows until the very end of the period. But so the moral of the story here is that we watch these to make sure that, hey, we've got plenty of buffer remaining to protect clients, but more importantly, we also look at how much upside that we have left. So, for example, these numbers over here for the Qs, we've got 85% of our upside remaining. Because what we don't want to do is have the market take off and have a strong run, and then we're setting in a product with no more upside for like the next 3 or 4 or 5 months. And so we not only monitor the current holdings, but on another sheet, we actually monitor a broader set of holdings that are held across our entire portfolio. And so, for example, we had a period where we had some holdings from June that had, really had a strong run. And in fact, they had realized more than 80% of their potential cap. And when that happened early in the year, we came to Mark and said, Mark, we think we've gotten most of the juice out of these, and there's an awful long time here before they expire. And so in our qualified accounts, where there wouldn't be a tax implication, we actually went ahead and exited those positions early and bought the current month so that we could get a new amount of upside and a new downside protection, so that we locked in those profits, so to speak. And so we monitor that vigorously. And so, we recognize that, hey, when you do these buffered ETFs, there's no free lunch. And we know we're giving up some upside to get that downside protection. But if we're, the way we try to make up for that is that, hey, if we've had a strong run and we've gotten most of the profit that we can get there, we'll go ahead and roll that into a current month where it makes sense and there's not going to be a tax impact. So, Mark, you have any comments on that?
Yeah. Thomas and his team brought these to us, replacing structured notes that we were using during 2022. And many of you heard me talk about, I kind of dusted off an old playbook I had from the Great Recession, where I was using structured CDs and we were using these individual buffered notes, and they're difficult to price and difficult to monitor and difficult to trade. And Thomas shared that they're actually more costly. And these buffered ETFs are relatively new, right? So what would you say, 18 months now, maybe coming up on 2 years that Innovator's been around?
So depending on the fund, I mean, Innovator's been around a little bit longer, but like for example, this fund PNOV was listed in 2019.
Yeah. So this has really been a good addition. But Thomas said, Mark, here's how we're going to monitor these every month, and we're going to look for the tolerances where we can sell out of them, reset inside of IRAs or Roth IRAs. And I thought that sounded good, so we implemented it. And as Thomas said, it's not every month, folks. It's every single week. We have 2 investment committee meetings a week. One is more strategy at the end of the week, and one is more operations. I would say. Would you call that, Thomas? Like where we're looking at cash, folks. Here's what you should know, and Emily really kind of runs these meetings as well with Thomas and the team, but. Every week we're looking at cash in holdings across the entire portfolio. So we make sure if you have a cash distribution coming up that we're teeing that up so it's distributed. Many of you get quarterly distributions. You get your quarterly paychecks from your investment accounts, and we make sure that money's available for you. We also want to make sure that we're not seeing significant amounts of funds just sitting in what we refer to as cash, really low paying, cash holdings in your Schwab accounts, where we'll just use money markets and sometimes a combination of our money market and short-term treasuries. But this happens every single week. And then on Fridays, typically we have a strategy meeting where we're reviewing the different investment strategies and things that may, what's working well, what's maybe needs to be looked at and changed. And we should just talk a little bit. I realize it's 11:18, but this is important stuff, and you guys are hanging around, so we'll make sure that we cover it. But these conversations are happening every week. Not this week because it's Thanksgiving. We won't have a meeting on Friday because we're all going to take the day off. But the nice thing about having this recurring schedule of meetings is that sometimes we can not have that meeting on Friday if it falls after a holiday, and it doesn't mean that your accounts aren't being looked at and monitored on a regular basis. And it's a really, really great process. And a lot of that was driven by Thomas and his team, and I appreciate that.
And so one last thing I want to touch on here before we wrap up, Mark, is that that same kind of monitoring illustration that I did with the Innovator example, and that's just an example. The monitoring that we do is not limited to the Innovator investments.
Right.
We build broadly diversified portfolios that include, different ETFs that are often low in cost and give us market exposure in key areas, as well as some mutual funds in areas of the market that we think make more sense to have a more active approach. So like we have a couple of bond funds, for example, that are mutual funds, and that still makes sense because the bond market is so much larger than the stock market. And big players have much more significant advantages in terms of the pricing on bonds and so forth. And so we have a few mutual funds that we use as well, but we do ongoing due diligence on all of the holdings in the portfolio. And we're long-term investors, and so it's not like we kick somebody to the curb if they have a bad month or if they have a bad quarter. But if we look at the long-term trends for a fund and we think that it's underperforming its relative benchmark, the benchmark or index for its part of the market, like, if we're looking at a small cap fund, we're going to compare it to a small cap index. We're not going to compare it to the S&P 500, which tracks large stocks. But we measure these things against their relative benchmarks. And when we think we need to make a change, we will. And so as we did our most recent set of due diligence on our the funds that we use in portfolios, we identified a couple of mutual funds where we felt like, we think over the long term, these things do have the potential to outperform, but it's not by a ton or hasn't been by a ton, and it seems like we're experiencing some downside. And so we came to the committee on Fridays and we did some analysis, presented some charts and analysis, and we made the recommendation that we're going to make a couple of tweaks. And so we rebalance portfolios twice annually, February and August. And so when we do the upcoming rebalance in February, there are a couple of mutual funds that will be exiting and upgrading to lower cost market exposure. So for example, we have a mid-cap growth fund that we're using that will be replacing with just mid-cap growth ETF exposure, which we already use in taxable accounts. And we're just going to start using that more broadly in qualified IRA and Roth IRA accounts as well. But the point that I'm making is that we're not a set it and forget it type of shot. We don't throw the baby out with the bathwater. We don't kick a fund to the curb over one bad month or one bad quarter, but we do monitor these things. We act as fiduciaries, and when we believe it to be in your best interest to make a change in the portfolio, we will. And so you'll see those tweaks, and you'll get an email notification about this, folks, when we go to do it in February. You've probably seen them in the past. But just know that we're in the background, we're doing those kinds of upgrades and evaluations, and you'll see some of those in the coming months.
Yeah, great. And I'm really proud of the work we do, and that just is a little insight on what goes on day to day regarding investment management. Thomas, I want to thank you very much. This has been very, very informative. I hope everybody has appreciated it, and I know you do. So, did you have something else you want to say?
I just wanted to recap the couple of key takeaways.
Sure, please.
Yeah. Yep. So folks, if I were going to summarize everything I said, if you're still listening, I'm thrilled because I know we've been on for a little bit.
No, we're good.
Number one, we are cautiously optimistic for both stocks and bonds in 2025. We think that a lot of the optimism that's been priced into the market since the election, could create some more muted returns going into 2025 as the reality of getting things through a narrow Congress, comes to, people, start to realize that. And we think that, given that stocks are relatively expensive, if we saw, the market get nervous about things, whether it's geopolitics with Russia or the Middle East or with China, or if there's, a tariff war or those kinds of things, you could see increased volatility, right? We still think long term, well, we're still constructive, but you could see the market do more of this, right? So, and then just have an expectation of more muted returns, right? The US stock market's up 20-some% this year. It was up like 20% last year. We don't expect it to be that high next year. We think a diversified portfolio, if you're getting 6, 7, 8%, over the long term, you're doing very, very well. And so for every 20% year, you're going to have a year that's softer or that's even down. And so we just want to manage expectations for those things. Thanks, Mark.
Yeah. Great points. Great points. Again, thank you, Thomas. And I just want to remind you of upcoming events. So December 14th, we're having an Army-Navy tailgate event at the American Legion in Newtown. You all should have received an invitation. If you didn't, let me know. It's going to be hosted by the American Legion and Joe Garvey. We all know Chef Joe Garvey, who's done wonderful events for us in the past. So the food's going to be great. We are also, again, hosting holiday movies at the Newtown Theater. You all know I love the Newtown Theater. I'm on the board of directors for that wonderful organization. And this year we're hosting 3 movies: The Bells of St. Mary, Christmas Vacation, and Little Women. And if you want tickets, we do have some tickets available. The cost of the tickets are only $5, but we do have, I think we've got about 10 passes for each movie. So if you want them, just let us know. It's on a first come, first served basis, but just reach out to us and let us know you'd like to attend. And in the spirit of, and then we have in December and January, I'm still working on dates, but in December I have a guest webinar with Sarah Brenner from the Slott Elite Advisor Group, and in January I have a guest webinar with Andy Ives from the same group. So really great topics coming up from our guests. And in the spirit of Thanksgiving, I just want to say to all of our clients, since this is a client only call, we appreciate you all so much. We really enjoy what we do with the problem solving and some of the great experiences we have with you, and helping not only you but your heirs and loved ones. And it's about the best job you can have. And I just want to say I appreciate all of you. Thomas, you too. I appreciate you being part of the team, and Scott and Arthur as well. And if my team's still listening, all of you too. We had a great Worksgiving a couple weeks ago, and we talked a lot about the team and everybody working together. But really appreciate everybody, and I hope you all have a great Thanksgiving. And I'm looking forward to seeing you soon. Thank you again, Thomas. It was wonderful.
All right. Thanks, Mark.
All right. Take care.